let's move on to the next theme. And the next theme that we have is around financial assets. This is for loans and investments. This theme should be of particular interest for those in NBFCs and HFCs. A couple of items in this clause would actually require you to really look at this at an industry level. It will move just beyond your company, but it's an industry-wide issue that you are now going to stare at. So what are those kind of changes that have happened? The loans and investments actually has 6 specific sub-clauses for reporting. The first subclause for reporting requires quantitative disclosures of loans guarantees given during the year together with the amount outstanding. And I will highlight to you what has changed between CARO 2016 and CARO 2020 as we look at the subsequent slides. All I'm trying to introduce to you on this slide is what are all the 6 subclauses that deal with reporting on loans. The other item which also should be familiar is the auditor will comment on whether the terms of loans and advances in the nature of loans are prejudicial to the interests of the company. Again, a clause which by itself is not new. This did exist in CARO 2016 as well. The third clause, which again should be familiar, is the auditor will comment on regularity in payment of principal and interest where these terms have been stipulated. If there is a loan or an advance in the nature of a loan where principal and interest repayments is not stipulated, that automatically becomes a reportable item. The next item is if there are total amounts that are overdue for more than 90 days, then whether reasonable steps have been taken for recovery or not. Now you will come back to me and tell me that items 1 to 4 were already in existence in CARO 2016. But the biggest difference is CARO 2016 dealt with these in the context of loans given to parties covered under Section 189, entities in which directors are interested or related parties, to put it broadly. But CARO 2020 takes that rider away. It talks about all loans, and that, as you can now imagine, just completely changes the dimension or the landscape you are looking at. Imagine yourself as a large NBFC having lakhs of customers and an auditor having to comment on the regularity in payment of principal and interest, having to comment on amounts that are overdue for more than 90 days. This is going to be a gigantic effort, both from the point of view of management and auditors. And this is something which really needs urgent attention at an industry level. The best thing to do would be probably through industry associations, reach out to the regulators, ICAI, and seek more guidance. And we will look at why it's such a big change that we are talking of. The 2 other new clauses that have been introduced include commenting on evergreening of loans. Those of you who have been familiar with the financial services industries will know evergreening of loans is an audit focus area throughout. Effectively, what it means is whether an entity has given a fresh loan or has renewed a loan to meet the obligations or loans that were falling due for the same borrower. This is an area of great audit focus for auditors of banks and NBFCs. This clause is now required to be commented upon across companies. So if, let us say, company A, who is in the trading business, has given a loan to another entity which is falling due in the current year, if the client or company renews that loan or gives a fresh loan to repay the existing loan, that will trigger reporting under this clause. So a very onerous requirement on the part of auditors. Evergreening is extremely hard to identify. It needs a very high level of skepticism on the part of auditors. Finally, the auditor will need to report on the percentage of loans and the amount of loans to related parties and promoter groups. And this is reporting again where the repayment term is not stipulated or if the loan is repayable on demand. So 6 clauses that deal with reporting for loans. I'll talk about each of them in a little more detail. The first 4 clauses sound similar, but the scope has been significantly enhanced. From related parties, it now goes on to all loans. Now, if you are an NBFC and you are worrying about how you will deal with this, there is slight respite. The respite is only slight because the NBFCs have an exception from reporting on evergreening of loans and from giving quantitative disclosures of all the loans and guarantees given during the year with the amount outstanding. Because otherwise, the entire loan book register of a company would feature in the auditor's report. But that's not the intention. So if you are an NBFC, items 1 and 5 out of those 6 clauses do not apply. The rest of the items are applicable to an NBFC. Now, what we will do is talk about each of these 6 and see what are the specific takeaways that we want to share with you. The first one around quantitative disclosure of loans and guarantees, as I mentioned in the introductory comments, this clause applies to all entities except NBFCs. This is a significant scope enhancement. CARO 2016 required this commentary only for loans granted to parties under Section 189, whereas CARO 2020 talks about all loans. Second, it introduces the concept of advances in the nature of a loan. So let us suppose you have a supplier to whom you have paid an advance. The audit team will now come and check as to what is the amount of advance that was placed. Is it a reasonable amount of advance, or is it really an advance which is in the nature of a loan? So if somebody gave 1 year's worth of purchases as an advance at the beginning of a year, this could potentially cause into question whether this advance is actually in the nature of a loan or not. So once again, an item which should be very carefully assessed both as management and as auditors. And finally, please do remember that if a loan is given and repaid in the same year, then that also needs to be assessed. Okay, so for those of you who are putting the questions on the chat box, my request is if you can also post the questions in the Q&A, just so that we don't miss out on those questions. So the first takeaway, enhancement in scope, item number 1 does not apply to NBFCs. Second, advances in the nature of loans are now covered, and loans given and repaid during the year are also considered. Another small nuanced point around this is that when you talk about loans to subsidiaries, associates, and joint ventures, the guidance note clarifies that the definition of subsidiaries, associates, and joint ventures is that under the Companies Act and not under the accounting standards. And you will recollect that the definition of subsidiary under Companies Act is slightly different from that under the accounting standards. So once again, something to be careful of at the time of reporting. These may not entirely agree with the RPT disclosures that you make in the financial statements. So like I said, the devil is in the detail. Some of these clauses are only going to be identified by looking at the guidance note in a lot more depth. With respect to comment around whether the loans are prejudicial in the interests of the company or not, again, as I said, this applies to all kinds of loans, all investments that the entity makes. It extends to investments as well. The guidance note has thankfully clarified that if you are evaluating loans, generally the key terms that one should evaluate will be the rate of interest, the security, the terms of the loan, the repayment conditions, if there are any other covenants, and the nature of the entity, and so on. So very important once again to keep in mind the context of the entity in which the loan is given. There are a couple of good examples that I would like to quote here. Let's say there is a concessional rate of interest that's given to a loan, that's given in a loan to a relative of the director. Now one could actually start evaluating that whether this concessional loan is prejudicial to the interest of the company or not. And at that point in time, one should therefore evaluate the context of this loan. That if employees are granted such concessional rate loans and the person to whom this loan was granted is also an employee, then basically this is under the normal terms of the company. This loan is not prejudicial to the interest of the company. When evaluating investments, one should really evaluate whether the holding company has the ability and the power to make this investment. What is the financial standing of the investee company? What are the sources of the funding, the valuation, the covenants based on which the investment is made? Once again, very relevant to assess that the loan that is given is not prejudicial or harmful to the interests of the company. And there are situations that one comes across where a loan is given to a loss-making subsidiary that by itself, without assessment of any other facts, would not be considered to be prejudicial to the interests of the company. So fortunately, the guidance note does clarify that it's not that just because the entity is a loss-making entity and there is an investment made, it's prejudicial to the interests of the holding company. Because you do see holding subsidiary funding structures to be very commonplace even in genuine business conditions. So extremely judgmental clause, but some safeguards available is the takeaway we would like to highlight. And if there is a non-compliance with an applicable law, so for example, section 186 is not complied with, those loans could have a high probability of being considered as being prejudicial to the interests of the company. So if there's a breach with the applicable laws, please do look out the guidance in more detail, because you may end up with having those kind of loans as being prejudicial to the interests of the company. This is my favorite clause because this is something that is very close to the financial services entities. What the clause basically tells is, as an auditor, you are required to comment the regularity in payment of principal and interest where these terms are stipulated. Interestingly, regular is taken to mean that the principal and interest are received when they fall due. So if I have an EMI which is due on 15th of April and I pay that EMI on 16th of April, then technically I have not been regular in payment of principal and interest. And if that NBFC or bank has given me a loan, then the loan given to me is reportable. Extremely practically challenging for the financial services entities, and this really needs an industry-wide debate. Because if one looks at the guidance note, there is a suggested reporting format. That suggested reporting format actually requires the auditor to list out all the names of the parties. Now, to just give you an example, if a trade receivable does not pay on time, there is no reporting on CARO. But if you're an NBFC and in your ordinary course of business, you have given loan to a company and that borrower defaults by one day, that becomes a reportable matter. So I think on this clause, for companies, these kind of instances will be fewer. Reporting list of items may not be as challenging. But if you compare this to the NBFCs and the HFCs of the world, this would be an absolute nightmare to deal with. And one of the takeaways is that the guidance note may use the term suggested reporting format, but as an auditor, if I place myself in the shoes of an auditor, I would look at it more like a mandatory reporting. So again, if you have not picked this item up with your auditors, please do pick this up with the auditors, and if possible, take this to the industry forum and look for getting more guidance. There is still enough time before the CARO opinion becomes due. And that is why I started off by saying that the theme is a stitch in time saves 9. Another very typical example which will impact the NBFCs and the financial services entities is the aggregate amounts of loans that are overdue for more than 90 days and whether the management has taken reasonable steps for recovery are to be reported. A couple of matters emerge from this. First is it is not compulsory for clients to take legal action. So if you are a non-financial services company, or if you're a manufacturing company, services company, it is not necessary that a legal notice should have been sent to the borrower. You are required to look at what are the kind of steps that the company has taken for recovery. It could be the nature of follow-ups. It could be the extent of persuasion to receive money. Those are the kind of steps that you need to look at. If an amount is not overdue, management has not done anything at all, that is probably a reportable item. If you are an NBFC or a housing finance company, you will need to actually take the aggregate of all the loans which have a DPD of more than 90 days. And one word of caution is this amount would not agree or tally with the amounts that you report as stage 3 assets under the financial statements. Because stage 3 assets are also driven by other qualitative aspects and not just days past due. So if somebody had to look at the stage 3 disclosures versus CARO, there could be some differences. And that's the point I wanted to highlight with respect to reporting for 90 DPD loans. Right, this clause around evergreening of loans is not applicable to an NBFC or an HFC. That's partly because the RBI expects those auditors to perform procedures for evergreening. If you are auditing a non-NBFC or a non-financial services entity, the reporting requirement is that if there is a loan or an advance in the nature of a loan which has fallen due during the year and that has been renewed or extended, or a fresh loan has been granted to settle those overdue amounts to the same parties, then such renewal, such new loan granted becomes reportable under this clause. So let me take an example. Let us suppose at the beginning of the year, company A has an outstanding loan that it has given of 100 rupees. During the year, it grants 3 more loans of 200 rupees, 300 rupees, and 400 rupees. For 2 of these loans, which is the 100 rupees on the opening balance and 200 rupees that was given during the year, when they fell due, the company extended the term of those loans. Now, what is required to be reported under CARO is the auditor needs to state that 300 rupees of loans in aggregate were evergreen. And when it comes to the percentages, that 300 is that percentage is computed with respect to the fresh loans disbursed. So in my example, the 300 of loans that are extended is divided by the total loans disbursed during the year, which is 200 plus 300 plus 400. And that's how you report a 33%. One interesting point to be kept in mind is that if the renegotiation or extension happens after the balance sheet date, but happens before the audit sign-off date, that is also to be considered for reporting. And the double whammy is that gets reported in the subsequent year's CARO reporting as well. So really, they're trying to take all possible precautions where nobody even evergreens a loan between the year end and the audit report date. Any renegotiation after the audit date, or rather after the year end, but before the date of the audit report is also reportable. And it gets reported in the current year's CARO and the next year's CARO. So very interesting items that come out on the guidance note. The last clause with respect to loans and advances is if there is a loan or an advance which is repayable on demand, or the repayment terms have not been stipulated into, then the aggregate and the percentage of those loans to related parties and the promoter group are required to be disclosed. So the gating question here is there a loan that is given which is repayable on demand, or is there a loan that is given without any stipulation of repayment terms? In either of those two situations, if they are met, one would then give the percentage of such loans to related parties and to the promoter group. So fairly limited applicability, not a very largely applicable clause. And those are the key takeaways that we had with respect to loans and investments.